If your CEO asks whether you eat plan this quarter, do you reply with your EBITDA or your net income? Welcome to Toyosi's Finance, where we break down money, business, and strategy in simpler terms. In today's video, we'll be looking at why EBITDA is an important metric when you're measuring performance in a startup. First, let's walk through an EBITDA using a real-life example. This is the P&L of Saaas. We have revenue of 10 million less cost of goods sold of 3.5, so we have a gross profit of 6.5 million. Then we minus 4 million of operating expenses for salaries, G&A, and other admin expenses, and we're left with an operating profit of 2.5 million, and this is the EBIT. The EBIT is the earnings before interest and tax. Then we deduct an interest expense of 300k, and we're left with a pre-tax income of 2.2 million, and then deduct tax of 25%, which is 550k. Then we have a net income of 1.65 million, and then we have EBITDA. EBITDA is actually earnings before interest, tax, depreciation, and amortization. And to get the EBITDA, I'll be starting with the net income, and then I'll be adding back the four items in the acronym, which are interest, tax, depreciation, and amortization. In the case of Techo, we actually have the net income at 1.65 million. We'll add back the interest expense of 300k, add back the tax expense of 550k, depreciation of 400k, and amortization of 200k, and that will give us an EBITDA of 3.1 million. So we have the same company, same quarter, same reality, and the net income is 1.65 while the EBITDA is 3.1 million. Now you can see that the number almost doubles each other, and then which one actually does matter? Here is actually why the gap exists. Two of those add backs are actually non-cash items, depreciation and amortization. Let's look at an example of depreciation and amortization. For depreciation, let's say you bought a server for your company in 2024 for 2 million. Accounting doesn't allow you to expense the cash all at once. You have to spread it over the useful life of the assets. So let's say 3 years. So every year, 400k is the P&L as the depreciation expense, even though you already paid fully for the server in 2024. So for depreciation and amortization, it's basically accounting just catching up for cash that already walked out the door. While amortization works the same way, but for intangible assets such as software licenses, goodwill. So cash already actually has been spent, but P&L cost is spread over time. So when depreciation and amortization is added back, we're basically just looking at the cash earnings power of the business. While for interest and tax expenses, actually very different because you actually do pay them in cash. So why do you still strip them out? Because they're structural decisions and not operating performances. Interest expense depends on your capital structure. A leveraged buyout and an equity funded company might have very identical businesses but very different interest charges. While for tax, it's very different because if you're in the UK, France, or the US, the taxes are all very different. So you have to strip them out because we're only comparing operating performances only, and that's the entire logic behind EBITDA. It answers the question or tries to answer the question. If we ignore financing, taxation, past assets that have been bought, how much is this business actually earning in cash from its operations today? So here's the private equity mindset. When a PE firm, say KKR, Bridgepoint, Providence, buys a company, three things happens after the deal. First, they refinance the debt, and that will change the interest expense. Secondly, they optimize the tax structure, and that also changes the tax rate. Third, they hold the assets that they have bought, and depreciation on those assets is a sunk cost that they cannot change. So for them, EBITDA actually changes three things that they cannot change or don't matter, and only leaves the operating performance that they actually bought, and that's why EBITDA is quoted in the PE data room. And here's the really important part. Valuation is actually EBITDA based. So when you hear that a company was bought 6 times EBITDA, it means that the enterprise value is actually 6 times the EBITDA. In an example of Techo, EBITDA was actually 3.1 million. So 6 times the EBITDA will be 6 times 3.1 million, which will give us 18.6 million of enterprise value. And this is why PE firms actually obsess over EBITDA. Because every euro of EBITDA that you actually add is worth 6 euros of enterprise value. So if you grow the EBITDA by 1 million, you're actually growing the value or enterprise value by 6 million. So CFOs in PE-backed companies are not just chasing EBITDA to feel good, they're actually chasing the EBITDA because it's a multiplier on the enterprise value that actually pays the fund's return. So in your board pack, which do you lead with? You should actually always report both, but you should lead with the one that aligns with your stakeholder. If your board is PE backed, then you should lead with the EBITDA. You should anticipate it, you should know they're going to ask for it, and you should put it on the first slide of your financial section. But if your board is equity based or VC backed, then you should lead with a three metric view: the revenue growth, the EBITDA, and the cash burn. The VC lens actually care about all three because unprofitable growth is acceptable to them as long as your cash runway supports it. If your board is audit based or family owned, then you should lead with the net income. It's the legally meaningful number, it ties to statutory accounts, and this board trusts it more than any adjusted metric. But whichever you lead with, you should actually always show the bridge between all four, starting with the net income to the pre tax income to the operating income and the EBITDA. So anyone asking can already have the answer in 10 seconds. So now let's have a quick recap. Net income is what you legally earned after financing, tax, and non-cash charges, while EBITDA is operating cash earnings power before tax and financing decisions. And the bridge between them is interest, tax, depreciation, amortization. And private equity actually uses EBITDA. It strips out what they're about to change and only leaves the valuation multiple they're buying. And in your board pack, lead with what aligns with your stakeholder, but always show the bridge. Thank you for watching this video. If you found it useful, give it a thumbs up and also follow at Toyosi's Finance. Goodbye.